Yo, 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 yo. What it do? Uh, that's your boy Gunslinger. And let's talk about the markets today, man. Let's talk about the markets. I'm gonna share um, one of my playbook strategies, which is the momentum play. And this is basically it works on all time frames, monthly, weekly, daily, 5 minutes, you name it. So let's get to it, man. It's the momentum play. And this is an easy, well, not easy, but simple strategy that anybody can apply. And it pays. So let's get to it, man. Right. Whoa. Momentum, rocking and rolling. So basically, this is a chart of the Euro USD. Marked this chart out this morning, and I identified this level down here, 760 level. That if this level breaks, momentum to the downside. So I just want to hop on like a lower time frame, and let's get it, man. Let's get it. So this strategy is pretty simple. Actually, you know what? Let me do my analysis on here, man. Let me do my analysis on here, man. So this level is broken, clean, broken. So this is the Euro USD daily chart. This level was 776, and now it's 740. So 20 pips down, and momentum play. How you play momentum is you basically, all right, before we get into that, let me explain what's going on here. So momentum, right? Momentum. Did I spell it right? Momentum. Right. So how this works is that you basically, in an uptrend, right? In an uptrend, you basically buy higher highs. And in a downtrend, so in an uptrend, you buy there after it breaks. And then you come and then price does its whole thing. You draw your support line there, your resistance line. And as soon as it breaks, you buy. So you're gonna buy there. And then you let price do its thing. It comes back. You buy. Just as it breaks this level, you buy there, right? And then price is gonna do its thing. And you keep doing this until, and you'll find that you're trading with the trend, because if price doesn't come to you, you don't get a position. And in a downtrend, so in a downtrend, we'll have lower lows, lower highs. And as soon as it breaks this level, you want to buy, you want to sell. So that's where your sell is going to be. And then as breaks, you got it on lock. And then pulls back, you want to sell lower than the previous low. So when price comes back down here, you want to sell and you're in here. And you just keep doing this forever and ever and ever and ever and ever and ever, right? And how you manage your risk on this one is, so let's take an uptrend, for example, right? In an uptrend, your buy is going to be above this line and your stop is going to be below this line. That's it. And then entry. And then your TP is going to be somewhere here. But I don't do TPs. I know where I want the TP to be. I know where price could potentially go to, and I'll just use support and resistance levels for that. However, when it comes to taking profit, I'll either trail the stop. Well, first things first, I'll trail the stop and remove the risk. So that's once like a position has generated about 100% on assumed risk. And then from there, I'll start dishing out or keep trailing the stop. That's one way of going about it. So in an uptrend, you want to buy the breaks of the highs, right? So price will do its thing, you make your money, and you get out, right? If you're getting out, if not, well, you got to get out, man. Otherwise, why are you getting in? You know, price will do its pullback, probably pull back to the level where you had entered. It won't happen all the time, but if it does, it could. And then it'll continue. And now you set up your next trade here. And stop goes below and your entry goes above. As soon as price comes, bam, you're good. You're filled. You have an opportunity to move your stop to break even, and you can decide what you want to do with your profits. And then as price continues, you just keep doing the same thing over and over and over and over again, right? Now, that was an uptrend. You're only buying in those scenarios. And in a downtrend, what we'll find is that price will be moving like this. So now we identify the previous low and we want to buy as soon as that low is broken. So that's my support line. I want to put my stop back here and I'll put my entry down here. And as soon as price comes, bam, it comes in with force because price couldn't break this point last time. But so when it comes here, in order for it to break this, it needs more selling pressure than it had last time. And if selling pressure is coming in right at this moment, then there's no time for a pullback. So that allows us to get our stop into a position where we remove the risk once we've made 1:1. And from there, we decide what we do with the profits. So we dish out, we keep trailing the stop. How do we rock and roll? And price usually has a pullback or retracement. And you want to identify the previous support and you want to sell as soon as the price or the market breaks this support level. And you want to have your stop behind this line, anywhere behind this line. And when price comes, bam, you know, and it can continue and fall and have these shallow retracements and your position is still in, and it can fall and fall and fall. And that's beautiful, man, because you just keep dishing and dishing and dishing out, and the market is paying you for what you did, man. Getting in, seeing the opportunity, and hopping in. So now that we've outlined the whole concept of what we're doing here, momentum play, right? So in a nutshell, this is what we're doing. We're trading momentum. Right? And in an uptrend, we're buying higher than the previous high. I know this is it might sound opposite to what people have heard. However, this is what pays, yo. This is what pays. I'm just sharing. And we're gonna look at the markets just now. And number 2 is downtrend. Downtrend. We're selling lower than the previous low. Because we're riding the momentum when it comes. It's like, yeah, man, we're just riding the wave. When the wave comes, we're riding that out, and we're trading momentum. So when momentum comes, we're not thinking a retracement. We're thinking this is momentum, baby. We don't know who could be behind either buying this thing or selling this thing, and exactly how much of it they're buying. So when we ride that momentum, yeah, man, we can ride momentum for hours on an intraday basis. We can ride momentum for days and weeks, even months on a long-term basis. So momentum, baby, it works on all time frames. And yeah, some might call it a breakout strategy. I call it my momentum play. And so let me get into like the pros and cons of the strategy. So pros, right? The pros is that the trend is in your favor, right? Number one, like price had to come to you in order for you to get filled. So I use stop orders to get into my momentum plays. And if price isn't going to come to where I want it to, then I don't get filled. And yeah, man, I mean, that means the trend isn't in my favor. And I'm like, okay, cool, right? So another thing is low risk to reward, right? Low risk to reward. This allows like your stop distance doesn't need to be very wide. Like I showed in the examples that I was doing. Your entry goes on the one side of the line, the support or resistance line, and your stop goes on the other side. So the line is that barrier. If that line gets breached and then price comes back above that line, then well, it's not valid. You know, you get taken out with a small loss, and we move on to the next trade. So, but the positive is that you don't need to have a wide stop distance, and that brings us to our next. It brings us to my next pro on this topic, and this is if you don't need to have such a wide stop, it allows you to leverage. It allows you to add more size. So instead of having like a, so on an intraday basis, instead of having like a 50 pip stop or something like that, you can do 20 pips, you can do 10 pips, and you're going for about 1:3, 1:5, 1:8, 1:10, all those wonderful numbers, man. It's limitless. 1:20, and when that momentum comes, that momentum is coming, right? So, I mean, if you risk 10 pips, and when you close out the trade, you're up 100 pips, man. That's momentum for you, man. That's momentum for you. And now, since your stop distance wasn't 50 pips, uh, you can actually size up your position by multiplying it by 5, since you're only going to be having a stop of about 10 pips. So 10 pips, and if you're going for 1:5, you're only going for 50 pips, and that's more doable than going for, say, 500 pips, right? That's because, I mean, the markets move 50 pips, 10 pips all the time. So these are very, very, it's targets that happen over and over and over and over again. So the nice part about this is it's a repeatable. It's a repeatable setup. You can do this every single day on every single market. Because when a market is trending, all it's doing is breaking its previous highs if it's an uptrend. And if a market is bearish and trending down, all it's doing is it keeps breaking all its lows. So if you're chilling by those lows and you're ready to rock and roll, you're good, man. You're good. So another, where are we now? Leverage, repeatable setups. Now we can get to the cons, right? There are pros and cons with everything, so let's not be ignorant. The cons is there could be weak momentum, and this has been calculated into the system, and weak momentum doesn't happen all the time. Most of the time you get momentum. You get enough momentum to do, say, get your position to at least break even most of the time, but it's not a perfect world. We do take losses as traders, but I mean, what's 1x versus the 10x and the 5x and the 20x that we're making when our momentum setup plays out? And it plays out. Trust me, it plays out. Weak momentum, right? There is a possibility. And I mean, if you do this strategy a couple hundred times, you're definitely going to see that you're going to get stopped out sometimes. Price is going to hit your entry, move a little bit. Maybe you do like 50% of your position and then pull back and take you out, right? And then it'll pull back to that support level. Maybe it might get some more buyers or sellers, and then pushes price to continue in that direction. So yeah, that's built into the system. We know this, and this is why I'm laying it out. We got to know the good side and the bad side, and we always got to weigh it. As long as the good side outweighs the bad side, then that's a positive, right? If you make more money than you lose, then you're going to end up net profitable. So same thing with this system. If it has more positives than it has negatives, it's going to be net positive, right? So next is deep pullback. So this is the same thing. Yeah, the market will go in with momentum, and the momentum wasn't strong enough. and then maybe the opposite side was waiting just under that level, and then they start buying it back up, and then it takes you out. And yeah, maybe that's the low or the high for the day, and you sold the low of the day, or you bought the high of the day, but you probably got taken out after just a few pips. You know, it's not like you let that loss run and run and run. Nah, you bought the low of the day, but you got out an hour, within a few minutes. And you're wrong, man. You knew you're wrong. You're out the market, and tomorrow you come back and analyze. So those are the pros and cons of this setup or the strategy or this play. Call it what you want, but yeah, man. Let's have a look at the Euro USD. Euro USD. This is the 5 minute. So how I analyze any chart is I start off by coming on to the monthly. And okay, let me check this out. Let me hit up trading view, man. So this is the Euro USD chart. And how I look at any chart is I start by analyzing the monthly. I go to the monthly and I'm like, yo, what's happening last month? What's happening the previous month? You know, before I want to determine what's happening today, I want to know what happened, or before I determine what's happening this month or what could happen this month, I want to know what happened last month, man. I want to know what happened last month. And come on, trading view. Let me see. All right. Right. So there's the monthly high for Feb. And we got this dark black line, right? Dark black line identifying last month's highs and lows, right? The high was 1.1099. And then over here it was 1.0781. So 1,099 was the high of last month, and 781 was the low of last month. All right. Now we know what the highs and the lows were. Good. We got information. Right now we need more information because we wanna make or wanna plan for a trade for the next coming weeks or days or whatever. Um, and we need more information. So next step, lower time frame, weekly chart. And what I'm doing here is I'm doing the exact same thing. I'm identifying last week's high and I'm identifying last week's low. Where we at with it? Right? Last week's low. Sweet. Right? Last week's low was 1060, and we've already broken that. Price started off here by last week's low. It came back up to about 1,244. And then it just sliced through, man. This is this week, right? So last week's low, right? Sweet, man. So now we come down to the daily. And what I just explained is that all I want to do is buy below the previous low. I mean, sell below the previous low, buy above the previous high. So this is a downtrend. if we apply that same strategy that I just went through right now. Okay, one more thing before we do that. Next step, hop onto the daily, identify yesterday's low, high, and identify yesterday's low. So that's all we're doing. We're identifying highs and lows, highs and lows. And this is pretty much where I stop identifying lows and highs, the dailies. I don't care much for H4 candle lows or highs. But I do look at the 5 minute. So this is what's happening right now. We are seeing price retrace, trace. But I'm on the 5 already knowing that this thing is bearish. So how some people would play this is they'd look to do a Fibonacci retracement and sell the 618. I would do that too. However, right now we are talking about the momentum. So this is what's happening. This is on the 5 minute. So this is my low. This is the low. This is the low, the lowest low that I can see right now. And this was formed a few minutes ago. So there's only one thing that I want to do here. I want to sell. To where? Let's have a look at the daily. Let's have a look at the daily. Well, we got all of this, man. That's where. That's to where. We got all of this. Let me show you. Let me show you. How do I get one of them rectangles out? Oh, right. We got all of this, man. That's all the meat on the bone. Not a lot of bone here, just a whole lot of meat. So from 750 to about 300. 350. That's 400 pips. Sure, why not? You every time price breaks the previous low, it forms a new low. And then it breaks the previous low, and then it forms a new low. And then it breaks the previous low, and then it forms a new low, right? And then it breaks the previous low, and it forms a new low. And then it breaks the previous low, and it forms a new low. So if I'm planning to trade the break of this previous low, it means I am anticipating price forming a new low, which means that I will be able to buy this thing back at a lower price and make a profit off my position. So we got the theory out the way. Now this is how you play this. I mentioned that the profit is about 350 pips, and this allows us to enter or time our entries, if I can call it that. But like I said in the presentation or in the what you call in the theory of the strategy, right? So say now we're risking about where's the entry of this? Okay, let me zoom in. right? So you want your thing to be your sell has to be below this line. It has to be, right? So say now your entry is at 71.75, right? Let me get my calculator. 70 716, right? And your stop can be about here, or maybe even somewhere right here. 700 and 750 51. That's about 35 pips, right? And your profit potential is way down here, which is 386 pips. So if we run the numbers on that, the risk to reward is what? 1:10. You risk 1 to make 10. So let's run some more numbers on this. Um, so right, 35 pips, and let's say you're trading 0.01. That's 10 cents per pip. You're risking $3.50 to make $35. I'll do that. All right. Now let's take it even one up. You're risking a mini lot, right? Mini lot is $1 times 35 pips, right? And you're risking $35 to make $350. I'll do that, right? Let's take it one step further. You're trading maybe, let's say, 5 mini lots. That's $5. $5 times 85. You're risking 175 bucks on this trade, and you make 1,750, right? I mean, this is the kind of trading that you can do, man. This is definitely what I do. And the nice part is when I'm risking that, say $35, that's only a small portion of the account. Like I don't risk nothing more than 1%. So 1% of the portfolio and we're good, dude. So now, say for example, you have $1,000 account, and then you risk $10 on that trade, right? $10 is 1%, right? So you're risking 1% and you're making 10%. So when you close out that trade, you have $1,100. And then you go take another trade, right? That trade maybe doesn't go in your favor and you lose 10 bucks, right? And then you take another trade. Maybe that trade doesn't go your favor, right? You lose another 10. Now you got 2 losing trades. Let's say now you get a streak of 3 losing trades, right? So now that's 5 trades that haven't been going in your favor, right? And then you go and take another one of these and you risk 10 bucks, and your risk to reward plays out to 10, 1 to 10. So you go and make another 100 bucks. And now your account is sitting at 1,150. So can you see the growth? Now you're up 15%. 15%, you haven't even taken 10 trades yet. But yeah, man, that's the momentum play. And this is how it works. So check out your Euro USD. Let's see how this plays out, man. Generally, I'm a dollar on the USD. However, right now I'm only looking at technicals. Technicals are saying down. So that's what I'm saying too, man. Uh, Peace out, yo. Have a splendid day and kill the markets, yo. Get your fair share, man. Um, Learn how to do this thing and do it. Peace out.